Stock Exchange Part 3. Fifth, protecting interest of investors. Stock exchange protects the interest of investors. In stock market, only the listed securities are traded. Stock exchange allows listing only after verifying the soundness of a company. The companies which are listed have to operate within the strict rules and regulations laid down by the stock exchange. This ensures safety of dealing through stock exchange. Sixth, liquidity. The main function of stock market is to provide ready market for sale and purchase of securities. The presence of stock market gives assurance to investors that their investment can be converted into cash whenever they want. The investors can invest in long-term investment projects without any hesitation. As because of stock exchange, they can convert long-term investment into short-term and medium-term or even liquidate their investments whenever they want. 7. Better allocation of capital. The shares of profit-making companies are quoted at higher prices and are actively traded, so such companies can easily raise fresh capital from stock market. The prices of securities traded in the exchange indicates the opportunities for investments. So stock exchange can facilitate allocation of investors' funds to productive and profitable channels. 8. Contributes to economic growth. In stock exchange, securities of various companies are bought and sold. Investors invest in companies which give good return on investments. Hence, companies too try to invest in more productive investment projects. This leads to capital formation as well as economic growth. 9th, providing scope for speculation. To ensure liquidity and demand or supply of securities, the stock exchange permits healthy speculations of securities. 10th, promotes the habit of savings and investment. The stock market offers attractive opportunities of investment in various securities. These attractive opportunities encourage people to save more and invest in securities of corporate sector rather than investing in unproductive assets such gold, silver, etc. Major stock exchanges in India. Following are two most important stock exchanges in India. First, Bombay Stock Exchange (BSE) was set up in 1875. At that time, it was called as the Native Share and Stockbrokers Association. It is located in Dalal Street in Mumbai. It is Asia's first stock exchange. It is the first listed stock exchange in India. It is the 11th largest stock exchange in the world in terms of market capitalization. It has the largest number of companies listed with it. Approximately over 5,000 companies are listed in the BSE. It is now a demutualized and corporatized entity registered under the Companies Act 1956. The BSE switched to an electronic trading system in 1995. The automated screen-based trading platform is called BSE. Online trading BOLT. The BSE has also introduced a centralized exchange-based internet trading system, BSEWEBX.co.in, to enable investors anywhere in the world to trade on the BSE platform. Second, National Stock Exchange (NSE). NSE was set up by a group of leading Indian financial institutions in 1992 as a company and was recognized as a stock exchange in 1993 under the Securities Contracts Regulation Act 1956. It started trading activities in 1994. It is the largest and most modern stock exchange in India. The NSE is located in Mumbai. It was the first demutualized electronic exchange in India. NSE was the first exchange in the country to provide a modern, fully automated screen-based electronic trading system which offered easy trading facility to the investors. The main index of NEC is the Nifty, which was launched in 1996. Important terms related to stock exchange. First, broker. He is a member of a stock exchange who is licensed by stock exchange to buy or sell shares on his client's behalf. He is an agent between the investors and jobber. His income is in the form of commission or brokerage. Second, jobber. A jobber is a dealer in stock exchange who carries on trading of securities in his own name. He buys securities as an owner and sells them at a higher price. The profit he makes is his income. He is a professional speculator in the stock exchange. He is not permitted to deal with investors directly. Third, bull. Tejiwala. A bull is a speculator who expects the price of a share to rise in the future and buys with the hope of selling them at higher prices to earn profit. His views are optimistic. Bull's actions leads to higher prices for securities as there is excess of purchase over sales. Fourth, bear. Mandiwala. A bear is a speculator who expects fall in the price of a security. Hence, he sells his securities at the prevailing prices to avoid loss as he expects further fall in prices. Bear's action leads to lowering the prices of securities as there is excess of sales over purchase. Fifth, stag. A stag is a member who buys new issues of securities from primary market and sells them later at higher prices when the securities are listed on the stock exchange.